When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone. This is John Galt speaking, and welcome to MacroEdge Radio. It is a happy Labor Day edition, a special holiday edition. We're going to have one of MacroEdge's very own as a special guest, Greg Crennan, economist, to come on and discuss everything we have witnessed this summer. The summer's coming to a close. We're going to enjoy this together, not only from a big picture perspective, but we're going to talk a lot of macro. But we've got news to cover also. Now, if you have not been paying attention today, this is the week of weeks. It is Junior Trader Week. Unless you're at Goldman Sachs, then your day ended today in more ways than one. And today's market swung over 400 points on no volume. We were down. We were up. We were down 200. Now we're up 228 to close out the day. NASDAQ 197. Looks like the S&P is going to go up, finish out up 5630. Doesn't look like it got above 5660. We'll see how this turns out, but it is insane, and we're going to see all kinds of crazy overreactions from the bulls and all of the players on Wall Street to sit there and advertise that the world is okay, there's no bear market, there's no recession, and just listen to what we say and do. Don't trust anything but what we tell you, and that is why you have to listen to MacroEdge Radio and some of our friends to get real facts. Read macroedge.net, Ozone. Get your 2-week free trial. Don't forget to check it out. We're expanding. We're getting bigger. We're getting better. And that's where we're going to go. In other news today, gold got plastered. Not unexpected at the end of the month. We have this happen all the time. Gold was at new all-time highs. They sold it off today. Once again, light contract volume. It's been one of those crazy things to watch and say, okay, it's going into a safety trade. Everybody wants to take that up. Everybody wants to deal with it. The truth is, it's all fluctuating around the U.S. dollar right now, and the U.S. dollar is all over the charts. It looks like a lot of people have gone short the U.S. dollar. Not a good indicator if you're a long-term investor. At 101.60, to be quite honest, the U.S. dollar index is a juicy short, especially against some key currencies. And rumors of the Chinese possibly liquidating up to $1 trillion in U.S. dollar holdings to boost their own currency and keep a clamp on inflation domestically to a point, maybe to get rid of some of that outstanding debt. Meanwhile, in the commodity markets, the softs had an interesting day. Also, I usually don't talk about ag, but that's why we got a moment here before our guest comes on. Soybeans made a run for $10. They didn't make it. And beans in the teens was usually a major inflationary indicator. We still have coffee, sugar, eggs, dairy, other products, cow, meat, you name it, up at all time, moving up on highs. But the ag's failing, and the indications are that farmers are starting to run into some trouble, is something to keep an eye on this winter, especially if you start hearing the two words, Chapter 12, being uttered on a more frequent basis. Chapter 12 is a farming bankruptcy. You will start to hear that as the real estate and other problems occur. Otherwise, why would John Deere be laying all those people off? Why are agricultural sales tanking? You have to ask these questions and start putting 2 plus 2 together, people. It's going to be a twisted, long ride. WTI and Brent got absolutely smoked today, and only word for it. WTI down 3%. It was down 3.2%. It's settling down a little bit higher. Brent down 2.3%, was 2.5% earlier on the announcement that the production limits might be lifted on OPEC and OPEC Plus members. That will lower oil prices heading into the election conveniently. However, we do have a scare coming our way. There are some of the models that are used by our forecasters indicating the potential of a strong hurricane in the Gulf of Mexico. sometime around the 9th to the 11th of this of September. So stay tuned. That could be something to watch. We can't trust it. The models are probably the same ones the Fed uses. That should be of great concern. Last but not least, one of my favorite subjects, the 10s-2 spread. We have made a run for zero for flatlining and disinversion all week long. That, in my opinion, is something worth paying attention to. That could become a major problem for the markets and the economy, because if you have a disinversion with Fed rate cuts later on in September and a bad inflation report next week, which I believe we will get another very bad, unemployment report next Friday, you add all of that up, you're going to see a lot of pressure on equities and no real reason to hold equities. I think we're going to see a very dicey market in the weeks ahead, and I don't think it is going to be positive for the markets in the long run. In fact, if anything, this is shaping up to look a lot like the summer of 2007, and potentially some old school days like 2000, etc. We are looking at some crazy times here, folks. There we go. That boosted up. Sorry about that, guys. I'm trying to do two things at once and get it in there. We have seen a breakdown in the real estate market unlike anything I've seen since 2008, and we're starting to see it shake down a little bit. I'm going to bring Mr. Awesome up. Are you available, Mr. Awesome? Because I would like to ask you a question real quick before our guest comes on. Ulysses Awesome, one of the MacroEdge's very own, and get him on board to answer a question for him, because we're starting to see a disturbing trend in the market. And that, I think, is also going to start impacting the banks, something that people do not want to talk about. And that is where we're going to have major concerns about the health of the regional banks and also many of the community banks. They're starting to see a breakdown. Credit unions are also merging at a much faster pace, something I haven't anticipated in a long time. And they seem to be leading the way. Especially when you start seeing stories about fraud, where there's one that reportedly had a $12.5 million mysterious charge. Oh, Mr. Awesome can't join us. Sorry about that. No problem, Mr. A. We'll catch you next time. The general trend of what's happening this week has been the bad news is being poured out at a record pace, and we don't know when, where, or how this is going to resolve itself. As the bad news hits the markets, it seems to be holding up well, but a lot of it this week was on very light volume, very reactionary, no real commitment by the traders to go long. And this could have just been short covering going into this weekend, because whoever executed that sell program this morning unloaded a lot of stock to get out of the way. Part of the subject matter we're going to cover today, if I can find my guest here, bear with me a second. I don't see him on the list. It is going to be about cumulative inflation and the asset price distortions we've witnessed. It has been a nightmare for the middle and lower class. And if you've read any of the articles posted at MacroEdge.net on Substack, you will notice that we're all seeing this trend where 20 years of nonstop economic manipulation, financial engineering, so to speak, trying to put off the day of reckoning, has finally started to come home to roost. And that's what makes me concerned about this. We don't seem to have a way out except for the old solutions. And the old solutions are print and pray, or have the federal government create a new program and pray. All right, Mr. Awesome did make it to it. Okay, I see he's there. Mr. Awesome, welcome aboard, sir.
Thank you. How you doing?
Not bad. My big question for you is this. We're starting to see a lot of deterioration in the multifamily arena at a rapid pace this week. I saw a lot of auctions, a lot of defaults. What the heck's going on?
Yeah. Multifamily is no different than any other real estate class. There's been a subset of investments made over the last few years that are not paying out the way that they had expected or hoped, and we're beginning to see even more weakness in that sector because of it.
It seems to be larger and larger. We're also starting to see hotels accelerate into this. Is this because of malinvestment, in your opinion, or real quick, is this more a problem with just oversaturation in some of these markets?
Sure. There's probably a combination of both. There's a mix of oversaturation, but there's also been some assumptions made in several real estate deals that rents are going to continue to go up. There's been some deals that were bad bets that were made where people purchased at a price that they thought they were going to be able to extract some equity out or increase operational revenues, and that hasn't panned out. A lot of it was also floating rate debt. So when interest rates reset, those floating rates, went from the historic lows of 2 to 3% to I've seen upwards of 10% current rates. So you're talking about an enormous payment jump in debt service for these properties.
That was my next question. Debt service is becoming a major concern for the industry. Is it hitting private equity harder, or do you think it's starting to hit the banks first and private equity is just going to hang on for the ride as long as they can?
Well, I think everybody is and will hang on for as long as they can. Although, much like office space, we're starting to see some, you call it jingle mail or deed in lieu, where investors are just saying, here, just take the property because we can't make the payments. But in general, you're going to see, more of this go on, and there's going to be more. I just think that we're at that point of the cycle where we're just beginning to see some of the distress in these two asset classes, but certainly there's more to come.
Well, the reason I asked is I saw some rather large liquidation sales this week in auctions, and the posting I posted earlier, that was a post from our friends at Nightingale Associates talking about the Pembroke Pines condo complex being evacuated. I was like, this is starting to become a very rapidly accelerating trend. And I don't think that the financial markets have picked up on the degree of deterioration of finances, not just for the middle and lower class, but for a lot of these multifamily, recreational, et cetera, investments. I was going through the numbers, and it does look like we're seeing the middle class end their vacation spree and start to realize these credit card bills are becoming due.
Yeah, certainly, we're seeing the higher credit card delinquencies, and as things are, progressively getting harder for a certain subset of the population, travel is definitely going to be one of those things where, it's affected, and especially in markets where that might be more dependent on it. Las Vegas, Orlando, typically the places you might see some of this spring up, but then also a lot of the smaller towns where they might be, a popular destination in a certain state where during the summertime they've got a lot of bookings. So you might see a lot of that pop up over the next 12 months as well.
Well, I appreciate you hopping on and answer those questions, because I think that we're starting to see some other trends that are disturbing. Everyone was paying attention to the nonstop funflation garbage that people have adjusted to the higher prices. I think that the long-term cumulative inflation is starting to catch up to reality for everyone. And I don't think people are aware just how much that will impact vacation spending and any and all available disposable income. Personal debt service has gone through the ceiling. If it's hitting them, and I know, and I don't know if you've heard this too, so if you've heard it and you can't talk about it, I get it. But I'm also hearing some PE is locking down withdrawals. If that's the case, it's going to get really ugly really fast.
Oh, sure. That's been going on for a while now, both at some of the bigger funds and then smaller funds. they're not able to meet withdrawals, or they're putting gates up. I think, and correct me if I'm wrong, Starwood is one of them, one of the higher profile ones. But a lot of these funds, they're invested in real estate. Real estate is not a highly liquid asset class. So to meet those capital withdrawals, that usually means either having to borrow that money or sell properties in order to make that work. So it's not something where I find that to be strange for the industry to have those. But if they're starting to put up gates, then maybe it's a sign of more people are wanting their funds back.
That's what I'm detecting too. Mr. A, I appreciate you hopping on. I'm going to just speak quickly about what's going on with NVIDIA. A lot of people talked about the NVIDIA earnings report and made a big deal about it, and rightfully so. It's the big stock on Wall Street. Everybody's been following it. I think that people are missing the larger picture. When SMCI blew up the other day, and rightfully so from a Hindenburg research paper, and nobody special has been covering this. We've had a lot of people. OrcaFin wrote a very nice Substack about it. It's very long. If you haven't had a chance to read it, go check out OrcaFin on X. He links to it in the conversation. And if you read it, you realize there are some things afoot that are not normal. Apparently, Hindenburg picked up on it, put out a huge report, and it does bring to light questions over the viability of long-term investing for our friends over at NVIDIA. Right now, there are people who are going to get some ugly, ugly bills who had 130 calls on NVIDIA that are closing out today because the stock closed at 119.37. So if you have 10 contracts, do the math. It gets very ugly, very, very fast. And that is going to be very bearish for the open of the market on Monday. People are not going to cope with this well, and they're not going to deal with it well. It is going to cause problems in the market. We've seen some moves in the background regarding liquidity protection, et cetera. We don't know what to make of this, folks. It's too early in the ball game, but you can see where people are going to panic, and you could start seeing some panic selling next week, especially if we get a U3 or U6 reading way outside the norm. And that is one thing that has that people aren't paying attention to, are those quote unquote mini black swans, the small black swans, not the big ones, that no one is prepared for. When you look at what's happening with this stock, it traded lighter volume on an up day, tremendous volume yesterday. And that has got to concern, as I wrote in the MacroEdge Wednesday night report, Mr. Powell more than anyone. He's sort of getting himself backed into a corner. You have a lot of short-term call options that got blown up today. The SOX, not really doing all that great. And you have to start wondering if the Fed has to cut to keep liquidity flowing to the markets and bail out some people. The news this afternoon, conveniently at 3 o'clock on a Friday on a holiday weekend, weird how that occurs, is that Goldman Sachs is laying off between 1,300 and 1,800 employees. You generally don't do that heading into the beginning or extension of a bull market. You generally avoid doing that. Oh, God, the breaking news hit after the market closed. SMCI files non-timely 10K with the SEC. No material changes expected in fiscal year and Q4 results ending June 30th, 2024. Thank you very much for posting that up, Six. I did not catch that. I was sitting here talking and reading from another screen on the article, and that should tell you something, folks, as to where we're at and what's going on. I cannot promise you that there's going to be a normal, stable market next week, because the way this is shaping up, we are seriously going to see distortions and some very, very wild swings, probably starting on Wednesday and right up until the Fed meeting at the 18th. That is going to be the number one thing to watch out for. We will see individuals having a change of heart for the long term, and are not going to want to sit there and deal with the Fed's games. They're going to want an immediate, and I do mean immediate, rescue from this situation. They're not going to want to sit there and fight through this. They're going to want someone to come in there and provide liquidity. They're going to want someone to come in there and buy the stocks. They're going to want quantitative easing. I don't think there's anything they can say on September 18th other than we will have the markets back. And that should be terrifying to anybody who's a normal, sane person in this economy right now. The economic data this week wasn't much better. If you looked at what we saw with unemployment claims, nothing happened. It was flat, 231,000, not a big deal. To be revised, of course. Some of the other stories, though, that are in the background, everyone was pointing to the uptick in the trucking activity of all things. And when you listen to that kind of commentary, you know they're reaching for things to point to a bullish outcome. Yes, there has been an increase in trucking activity. Yes, the prices have finally started rising a little bit. But what they're missing is that truckload index is still greatly suppressed down towards 2019 and lower levels, while at the same time, more of the shippers, the Walmarts, the Targets, etc., are turning around and basically setting up larger private fleets, a very expensive proposition. But if you're a Walmart, a Target, etc., you can afford to do that and avoid the traps of the whims of truckload carriers who go out of business. And a lot of truckload carriers have been going out of business. A lot of other problems with the rails have been occurring. And right now, there are containers stacked up to the ceiling out in Los Angeles and Long Beach for one reason. There is a fear of the longshoremen going on strike at the end of October. And at the end of October, should they go on strike, we're going to sit there and witness a disaster for the election for the Democrats. It will impact the markets. It will impact people's sentiment to have their quote unquote group protesting against the leadership and causing economic hardship for the rest of the country. This will be a month of change leading into this. The debate on the 10th will provide some interest. So you have some key dates coming up to circle on your calendar for September. You've got next Friday to deal with the unemployment report on the 6th. You've got the 10th with a debate, the 18th with the Fed. And you also have that period between the 10th and the 18th to watch the tropics, which is the peak of the hurricane season. Any kind of activity heading into the oil patch will stir things up, will cause people to freak out considerably, and could quite possibly change the direction of inflation and what the outcome is for the election, believe it or not, if we continue to see higher prices carrying in. Today's PCE report was quote unquote on the money. The truth is, I don't think that they're ready for any kind of major price swings due to a declining dollar and an increase in oil. No, they're just completely out of their league on what to do about this. And that should be of concern to everyone. Moving on to the next subject, I'm hoping I can get someone in here to talk about the tourism situation, because this in Florida, it's not a problem. I've not seen any problem, in fact, in Florida. I've been to Orlando, to Universal several times recently, and it is absolutely buried with people. Reservations at hotels are still substantial, like 80-90% occupancy on weekdays. You've got individuals who are willing to spend thousands of dollars on vacations from China, Brazil, all over the United States, flying into Orlando. The winter season in Brazil and Latin America must have been strong enough for them to justify flying up to Orlando and spending their time there, because they were absolutely overwhelmed. But in other parts of the country, especially the expensive regions known as Hawaii, things are not so good, are they, Kalani?
No, not so good. Hope you're doing well.
Doing well, sir. Go ahead.
Just can you hear me okay? Hello? Can anyone hear me?
You
Hello.
sound fine, sir. There we go. There goes my mic stuck for a minute. Bear with me a minute. I hate that button when it gets a little bit of grease on it. And that's all she took. Yeah, no, you sound great, Connie. Yeah, please go ahead, sir.
Oh, no worries. So, July numbers for tourism came out just a couple of days ago for Hawaii, and where I'm from, Maui, has obviously been hurting the last 12, 13 months since the Lahaina fires. And I don't think all of the weakness in the tourism numbers can be attributed to the fires, though. As numbers across all islands are down, but Maui traditionally is the most expensive, has the most expensive room rates, and is the most premier destination of all the islands. So, some hard numbers for July: the number of visitors were down 20% year over year. As far as spending in dollars, for July, the spending decreased, looks like almost 18% year over year versus the previous July. And the numbers, like I said, for other islands are not as have not decreased as much, but it's still obviously pretty concerning. And uh, that's it. I think you're right when you said that the more high end or pricey destinations are the ones that are getting hurt. I'm not sure, how a family vacation to Orlando compares to Maui, but I don't think it's anywhere near the same amount. So
Well, I've heard the Big Island is suffering too, but I think a lot of that has to do with the active volcano and earthquakes is scaring some people away. Tell me if I'm crazy, but I've heard that it's gotten somewhat shakier out there.
I was just actually on the Bay Islands for a week last week. It certainly didn't seem busy to me. I was on the Kona side for a few days, and it seemed very quiet. I don't have hard numbers for the Big Island, but it seemed very quiet to me.
I'm not allowed to go to Kona anymore because last time I was out there, the market crashed. So I'm getting banned around the world from traveling. Every time I go on a major vacation like that, the market crashes. And that does cause a bit of a distortion because anytime I announce my annual fishing trip, it's like, what? There's a little bit of a freak out for the people who were around almost 20 years ago.
Right. I do have some Oahu numbers. Looks like, let me see. Looks like Oahu, as far as July, number of visitors were up slightly, less than, looks like 7%. But versus pre-pandemic, it's still down more than 5%. Visitor spending on Oahu was up, looks like 14%, but versus pre-pandemic is still down significantly. So, I think price, as we evolve in this economy, some of us, think we're already in a recession. I think that people are becoming a lot more price conscious. The vacation packages to Oahu are a lot cheaper than they are to Maui.
I can understand that, sir. We just to give you an idea, a family of four. I can't quote Disney because I just refuse to go there, personal reasons. It's and political, but the overall cost of going to Orlando, say from the Midwest or the Northeast, with a family of four, you're looking at a minimum of $5,000 for the week, including airfare, and that's a very minimalistic vacation without the extra perks of express passes or the very nice dinner out or the larger room. So it's starting to match. And unfortunately, I think the days of financing your vacation with your credit card are coming to an end with delinquencies starting to skyrocket. That is the key thing that I wanted to get to next. Delinquencies on the consumer level and the crash of the low-end retailers should be a warning more so to Wall Street than it is. And I think a lot of people miss that. Kalani, you've had experience on Wall Street. Generally speaking, they don't pay attention to the lower-end retailers as much as they do the big boys, correct? Nope, I lost him.
No, I'm here. I'm here.
Okay,
That's been my experience. Correct. That's been my experience.
Yeah, the Dollar Trees and Dollar Generals are basically dismissed as that's where the poorest go to shop, so who cares?
Correct.
That's scary because I don't think they realize what an economic signal that is. And it is an economic signal, people, because if you have 80% of the population not doing well enough to maintain their lifestyle, they will stop spending and they will cut off their spending and they will sit there and pull their wallets in, pull their credit in, and not spend money anymore. Before I go any further, quick reminder, MacroEdge.net Ozone, MacroEdge.net Ozone. Go there, subscribe, get the 2-week free trial, see the data that keeps you ahead. You may not like how the data is being reported by the federal government, but you will like the actual hard numbers we try to provide as a service and keep the reader informed to make better, more informed decisions for your investing future. Moving back to the delinquency situation, car repossessions are up if you haven't been paying attention, people. And if you are not watching all of these things that are impacting the lower and lower middle class, you will find out quickly that we're going to see a collapse in every industry. It started off first with RVs. Recreational vehicles have been dead for nearly 6 to 8 months. It's hit the yachting and marine industry heavily. I looked at some more numbers this week. The recreational boat industry is in an absolute free fall. There were numbers of 45% decline in sales and unit sales, 60% declines in unit sales. We're starting to see anything that requires financing deteriorate at such a fast pace, we can't keep track of it. And we're going to start seeing more layoffs in all of these industries. And these are the people who spend money, not just at the Dollar Generals and the Dollar Trees, Big Lots. Prime example, more real estate about to hit the market. Big Lots is probably going to file for Chapter 11 in the next 2 to 3 weeks. We're watching the stores that are being liquidated locally. We're starting to see a little bit of panic more so in the other locations. These folks are your average lower middle class individuals. They're the ones who have been going to Walmart for years, not your high-end, high-dollar big spender. They're the ones who helped Walmart grow and take off. So I can't tell you what the consequences of that will be from the Walmarts of the world. People are still going to go to Walmart to buy their products, to buy their groceries. The problem is going to hit when you see the high-end retailers were starting to report deterioration. Macy's hinted at that. Nordstrom sort of hinted at it. But you're starting to see concern when you see the Swiss watchmakers and those start to say, hey, sales are down, folks. We're having a real historical problem. And resales on Rolexes are down also. Not at levels that we've seen after a major stock market crash, but there's still time for that to occur. I do agree that Kalani Hindenburg is very thorough. So with everything that we see coming out of this industry and the AI ghost industry, in my opinion, it will be a nightmare for everyone to endure. We lived through this before, folks. If you remember 2007 and 2008, all of these companies that were struggling penny stocks added the word blockchain to the name of their companies. And that was supposed to be the be-all, cure-all for their just god-awful equity prices and the cure for the bear market that was besetting everyone. Instead, it just simply indicated it was a weak company, unable to hold on to its position in whatever market, and it's going to sit there and happen again. We put AI into everything, in every financial report, and it's going to blow back on us in a dramatic way. And that should be your warning for where the economy is heading. As people default, as people are unable to pay their bills, as people become unable to pay their car payments and their mortgage payments, and unfortunately, their credit card payments, and are relying totally on government assistance, the rapid descent and deterioration will blow your mind. A lot of people said that the employment situation is stable. If you've been following the numbers that MacroEdge publishes, a very excellent series, a most excellent series of reports, I should say, they were able to highlight some points that a lot of people don't understand. And what a lot of people think is going to happen and what will happen is this. You're going to see a trap door opening in the future. And unfortunately for the American people, when that trap door opens, nobody's prepared for it. The door just opens. It's a straight line down. You'll see unemployment increase. Would I be surprised if we saw 4.5% 4.6% next Friday? No, and that's U3. We could get north of 9% on U6 in very, very fast fashion, and nobody will know how to react. The next key is watch what happens in October when the early retail hiring season begins. I don't think people understand that once that season hits, once this begins, you're going to see whether or not they are anticipating all this inventory they're bringing in early is going to get sold at normal retail prices, or if the cumulative inflation has finally beat the individual down to the point where they're just going to minimally spend this Christmas and really set back all of the economic theories and forecasts for the rest of the year and most of next year. The election is going to play a huge part on it. I'm not going to vent any more about the election. I think most people know my political leanings, and that is they all suck. That is why I'm sitting here trying to look at it from a numbers perspective and from a base perspective. We are in a good situation in Florida where we don't have to worry about instability in our local economy. It's sort of a privilege to have a governor who is pro-capitalism. But in those states that are subject to, shall we say, less than ideal economic circumstances, like Tim Walz's Minnesota, it is going to get very ugly very fast. Okay, I got Faison who wants to request to come on in here. Let me get him on the screen here. And there he goes again. We're just having a great time with this X feature today. It has really become a nightmare. Let me prove you. Okay, Faison, come on in, sir. I think I've got you in there now. Are you there,
Thanks.
sir?
Yeah, thanks so much for having me. All right, so I mean, I do apologize. I did join not too long ago, just probably a few seconds, not even a few minutes ago. But coming into this Labor Day weekend, it's hard, right? It's hard because even though a lot of us might have jobs and we're employed, I think we know that there's plenty of people out there that are, suffering, having a hard time finding a job, and that's why ultimately they're suffering and they're applying. I think the whole apply, the way you apply for a job is just all screwed up. I think Indeed was a really good platform to start applying for jobs, for applying for jobs for many, many years. But now with all this AI bull crap and all this data collection bull crap, they're in the freaking dumpster, in my opinion. I hate Indeed. I think hate might be a really aggressive word, but I would say that, I have a dislike for them. That's not my first choice anymore. Let's go to Indeed.com and start applying for jobs. Repeatedly asking the same questions, repeatedly collecting the same, data. It's so clear cut that all you're doing is you're taking my data and you're probably selling it to the government or somebody that's going to make up some bullshit numbers.
Absolutely. Faison, thank you for your 2 cents on that. It's what we found out about the Indeed and a lot of the other job services is that they have juiced their numbers, so to speak, and that there's like a 40% of the jobs are fake in most of the corporate and the rest of the world. It's not a unique situation to Indeed or Career Builder or any of these services. They've just adopted a model of, okay, we can't make money advertising for jobs because the jobs aren't there. So we're going to turn around and, hey, let's try this. Let's try data collection as a side business. And data collection is huge. If you ask anybody who's in the industry, collecting data and reselling it is a major, major aspect of this. And we have to sit there and analyze how this will bear out in the future, because what most people don't want to talk about, anybody who's a member of the MacroEdge team will tell you, the JOLTS report from a methodology perspective is a total joke report and actually does not sit there and provide the data that the Federal Reserve thinks that it does, nor that anybody else who's making economic projections. It's stale data, number one. Number two, it's information that is distorted by duplicative listings. If you're counting a job on Career Builder and you're counting a job on Indeed and you're counting another job, and then you rotate it out and bring it back 3 weeks later and you count it again, you can see how the duplication and duplicative nature of this methodology will lead to distorted and irregular results. That's why I have problems with those. And before anybody says, well, it's been that way all along, they're correct. The newspapers were notorious for it. When they were using newspaper want ads originally, they were sitting here and counting it. And if it was in the Sarasota Herald Tribune, the Bradenton Herald, and the Tampa Tribune, and the St. Petersburg Times, God knows why anybody would read that paper, they would count that as 4 jobs. They wouldn't count it as 1. It was counted as 4. So you have overlapping data points that are absurd, absolutely absurd. And that's why I'm trying to say you have to look for more accurate sources of data. We try to provide that at MacroEdge. And in this humble host's opinion, what we're going to see heading into the next 3 months, the next 90 days, will be the 90 days of hell for the American investor and the American public. We have no clue how it's going to turn out with regards to politics, geopolitics, etc. But the bigger picture is this. I don't think the economy has been under this kind of stress, this kind of massive attack from all sides since the 2008 crisis, since the 2000 election, which if you don't remember, folks, it was decided by less than 600 votes in the state of Florida because of hanging chads. We've had these kind of implosions throughout history before. John Hussman writes some excellent stuff. I don't know if you follow his stuff, but he actually has some very excellent papers about this. And one of the things that he introduced was the 1929, hey, check this chart out. Start doing some comparisons as far as the stress levels on the economy, etc. You start comparing the stress levels from that era, from the 70s, from 87, from 90, from 98, from 2000, etc. You start going down through the markers in history. We had massive market moves and corrections. You can see how we could end up with a major problem unexpectedly, a mistake. NVIDIA might well have been that mistake. I'm throwing that out there for everybody to consume and think about and speculate. You protect yourself in your own investments. Don't depend on the market financier class to tell you how to sit there and do it. Their interest is to sell more stocks. They are actually pushing stocks that have crashed 30, 40, and 50% as buying opportunities now without understanding that they can crash even further, creating more problems for the poor sucker, or as we call them, the retail bag holders, to take it off their hands, get it off their books so they can ride off into the sunset. That leads me to where I think this asset price distortion has come in. We've put so much money into the system via the Federal Reserve. We've put so much money into the system via fiscal stimulation, which has been targeted but not executed properly, that we are creating a bubble of such massive proportions, the proverbial everything bubble. If we don't get this corrected with an actual deflation of some sort or disinflation to a major degree, a real contraction in economic activity to get rid of the excesses that we failed to get rid of in 2009 and 2010, the coming crash could be a long crash. It could be a decades-long crash. If you don't believe it's possible, ask Japan. Japan's paying for it. And now they're about to see a major crisis over there because they thought they had this under control. They thought, hey, we intervened. We scared the hell out of the speculators in the market. The yen surged in strength. Look what happened. Well, already today, it's back over 146, and there's no indication that people want to use the yen as a hedge for anything. And the carry trade still has more to unwind. They better watch out because if they get their wish, they could end up crashing the markets again like they did recently, and it will get very ugly fast. Asset price distortions are a thing that we've seen everywhere from real estate to auto prices to yacht prices to RV prices to grocery store prices. You name it, it's distorted. There has to be a correction, or there's going to be a bigger price to pay in the end. Pardon the word overuse of the word price. Lastly, I think the outcome is going to be pretty obvious. We're going to have a stagflationary recession. Some people are calling for an inflationary recession. Greg has made it. Sorry about this, folks. It was a long time coming. Greg, are you there? Oh, we're hoping he gets there. Greg, can you hear me?
Yes, John. Good afternoon.
Good afternoon. Thank goodness you made it. How you doing, sir?
Great. Thank you. How's everything all right?
It's going good, sir. It's going good. This is our guest, Greg Crennan, economist extraordinaire, in my opinion. You're going to find a lot of what...
I appreciate it. Thank you.
Well, I think what our listeners will find is that we have a lot of parallel thought processes. First, do me a favor, introduce your Substack, introduce yourself. Tell us a little bit about yourself, what you want to write about, and then we're going to get into some of the economic discussion that I've been ranting on for the last half hour.
Sure, absolutely. So, Greg Crennan, I'm chief economist for Golden Coast Consultants, work with wealth and portfolio managers on how to build and protect their portfolios based on economic data. So I do a lot of analysis, things like interest rates, balance sheets, reporting on company 10Qs, and then help people, ever since the government went on a massive printing spree, I felt like that I needed to be more vocal and make my presence of knowledge more aware to the masses. And so that's when I really got onto social media to help people understand on the craziness that has been happening really since 2019, when we started the non-repo crisis, which actually, it's ironic, exactly 5 years ago this month is when we had the repo crisis in 2019, and that's when we've been on this crazy path since.
Well, okay, let's go right back to this. We had the problem the Christmas of 2018 that was basically swept under the rug by our friends at the Federal Reserve with the Christmas Eve, hey, we better cut rates and let everybody know we're going to cut rates to save the stock market. Are you starting to see those kind of stresses like I am throughout the financial system? Maybe not in one large cluster event like that, but are you starting to see the same patterns evolving now?
Yes, absolutely. So, when looking at, say the past 24 years, really since the bursting of the tech bubble, the Federal Reserve, usually we're using the repo market and the overnight repo. So you can actually see if you pull up their data, they were using repo ops during the 2000 burst, and then especially from 2006 to 2008. It's well documented that the Federal Reserve was basically taking bad loans or bad debt off of banks' balance sheets and then giving them new collateral via cash to make it look like they were more solvent than they really were, until obviously everything got exposed. And so what we're seeing today is something similar, but instead of the access through the repo markets, we're seeing it through the Bank Term Funding Program, the BTFP, which is exactly something very similar, except these are loans that have to be paid back. And so we're seeing that come down from the peak. It was 170 billion down to 98 billion. So there's still a lot of cash sloshing around the system, but that is dwindling. And by looking at last year's data, we saw the massive spike in the fall of last year. So that money is coming up on its 1 year because that money has to be paid back, and that's why the fund has been being drained. And so we're starting to see those numbers come down. And so what that does is it's going to be a lot harder for the banks to show that they are more solvent than that they've been reporting over the past year.
So with that happening, and I'm sorry, I was talking earlier in the program about the stress I'm seeing in the credit union arena, and I'm starting to see mergers, fraud stories, et cetera, which is a direct local impact, folks. It's local lending at its very best. When you start seeing it at that level, it usually progresses up through the community banks and then on up to the regional banks. Is there any indication the Fed really has any program beyond the old BTFP to start engaging and stopping this? Or are we going to see another reactionary phase where let's let it get really bad first, then we'll have the big banks come in and try and bail everybody out?
Yeah, and that's one of the things that we ask. And if you do, there have been some video clips that I have shared via on social media that Federal Reserve Chair Powell has stated to in his conferences to the banks and to the media that, hey, use the discount window. Now we have seen actually recently we've seen less use of the discount window, but there's been other Fed talkers on the governing board saying, hey, please use the discount window, but we know it can be clunky because what happens is those banks that go to the discount window, those names have to be exposed. And so we all know that when you're going to the discount window, it's usually one or two things. One, it means either you're insolvent, or two, you're holding collateral that is dog shit, and no one wants to know, you're holding that dog shit. So it's a combination of either collateral issues or insolvency issues or both. And so that's why there've been talks about changing the discount window. So basically, we can just keep everything hush hush. And so, but that has yet to be changed. So that's still one of the things that are out there that I also keep my eye on. There were some recent spikes this year in the discount window. And so, there's definitely, the old saying, where there's smoke, there's fire. So, when I see those spikes, to me, those are always signs of smoke. And then that means that there's somewhere a fire that we can't really find exactly and pinpoint exactly what it is. But when you look at the banks, and recently, like Bank of Montreal stating that there's credit stress, I mean, there's many banks that have been warning about credit stress. We're seeing it in the credit card delinquencies. We're seeing that the loss provisions have been rising this year in all the bank earnings statements. And so they're putting capital aside for credit losses that are going to be that are happening now and that will be happening in the future. So, as far as when the big credit event happens, that's still to be determined. But, from what Federal Reserve Chair Powell said, what other Fed governors have said, and what the data is showing is that there's something in the forest that is burning. We just don't know where exactly it is right now.
Yeah, I found it interesting that there was no discount rate cut this month. I don't know what your opinion is on that. I really thought they were going to try and get aggressive and get ahead of it to cushion the blow of the cut next month in the Fed funds rate. I was shocked they didn't take an action on that this month.
I don't think so. I think when we're looking at interest rates, the market has already priced in that cut, right? So the long end of the curves have come drastically down. We've already seen that the 30-year mortgage rates have dropped from over 7 back down into below 6.5. So, that easing has already taken place on that lower interest rate speculation, because they haven't done it yet. So that easing has already happened. And listen, if they decide, say if we have a good jobs report next week, they could decide, well, maybe we'll wait another month. And if they do pause and not cut this month, even though it's 100% priced in and everyone's expecting it, that would almost be like raising the interest rates, which could cause actually more stress in the system as everyone's waiting for these rate cuts to come. And so, we'll see how the next 18 days of data comes out. But like I said, you said most of the data points to a rate cut, and everyone's either betting on 25 or 50. But if they don't, for some reason, if the data tends up to being better than expected, there have been some comments that maybe they would wait till the November meeting. So, definitely some interesting 18 days ahead.
Oh, I think it's an interesting 90 days ahead, to be quite honest. Between
yeah,
I think everything
definitely the next 90, but definitely also the next 18, because this is supposed, right now it is 100% priced in for a cut. So, we'll just have to see over the next 18 days if something changes between now and then.
The reason I bring that up is that I'm looking for a really bad number on Friday, and a revision down for last month. So I think we're going to see a bad employment number to give the Fed their cover for 25 or 50 basis points. I think 25 will disappoint the market. That's just my speculative analysis of this, because even though they brought mortgage rates down, that has nothing to do with helping affordability, et cetera, across the board. And it gives business no incentive to go out and borrow money for long-term capital investment with this much uncertainty.
I mean, I completely agree with you on that. But the issue more so is the Fed's credibility, which is now on the line. And so and also going to your point that the jobs revisions have the revisions lower was always happened after the initial reports. So I wouldn't be surprised actually if the report is actually decent or just in line with expectations, still showing growth. And then, later say after November that the revisions are really bad, because that's what the trend has been, is that the initial data is good. And we all know that the numbers aren't really adding up, which has actually allowed, if you think about it, if the data was reported correctly over the past 12 months and more, where all the revisions actually came in lower, that then means that all the initial reports that we beat on the jobs number would never beat. So all the past job reports would have been like, we missed jobs. So imagine if the headlines were jobs comes in lower than expected and the Fed raising interest rates. That would have sent out a more of a panic than the way that it initially came out. And so I'm not saying if that was intentional or not, but it definitely would have put a different stance and feeling on where market thinks how things are actually progressing in the actual economy. And so when looking at that jobs data coming out next week, I mean, I wouldn't be surprised if one, it was bad, or it's decent, but when we actually look into the real data, it is bad. But the headline number, which is the only thing that the media really cares about, would be better than expected. And so, yeah, we'll just have to see how that data goes. We know the data is getting worse, and there is a lot of lag, and a lot of that data can be revised down up to two. Basically, this entire year of data can be revised lower, and they can say, yeah, we really messed up. So it's very complicated situation because of these revisions, and because that's the other part. We really don't know what data is real data because of all the revisions. And so that actually makes it hard to make good decisions on investments due to that the data keeps fluctuating positively and negatively, but really mostly negative.
Yeah, I'm going to go ahead and throw my neck out in the line. I think we get a sub 100,000 number this next week. I really believe that.
Yeah, no, I mean, I think that's kind of like where the numbers have been really over the past 12 months have been sub. So, I mean, absolutely. Now, whether or not that's the official number or the first number is a different, story. So
I'm going to go with first number because I really would just like to sit there and watch the entertainment of listening. That's the only time I tune into CNBC is for events like this, because it'd be like, oh, this is going to be fun.
Right, absolutely.
Moving on, one of the things that we've been talking about is the cumulative inflation and the impact on asset price distortion. Give us your take on where you think how that's going to have to be resolved. I think we require absolute deflation to fix it, and a deflationary recession / potential depression to do it. In the old days, we had that done in 2 years. We've built this up for almost 20 years now, thanks to Greenspan. What resolution do you see, or do you think they're going to go for the hyperinflation / stagflationary recession, or worse, and pray they don't break everything?
So that's many people are wondering what's the way forward. And so when I'm looking at the way that I see how our current fiat system is based off of, and I really truly it's just based on money supply. We really want to see that money supply stabilize and not rise. It has kind of still down from its record high, but I think that we had such a massive increase in such a short period of time that now that the money supply has more plateaued, it's not really rising, it's not declining anymore, it's kind of like stabilizing. We're now really just catching up to that massive increase in money supply as a whole in an economy. And so you're seeing, certain price shocks now, like insurances are rising now, right? So, when you had the first initial spike in money supply, you had all the immediate things go up in price: food, energy, shelter, because that money was direct. That's what people wanted. So you saw those prices shot up. So now that has calmed down, you're seeing other people realize, well, car insurance, well, more people are getting into car accidents, labor costs are more expensive. So now, for us to be a profitable insurance company, we need to raise prices, because every time that we run our costs are more expensive. So now they're raising their prices. And so we're seeing some of those other lags in inflation that are just catching up that really didn't have the effects when we had the first initial big inflation spike. And so now running to the government, there's the issue of fiscal and monetary policy. And when you're running these deficits of $2 trillion, that's extra money being pumped into the economy. It's also a sign that the economy is very weak, meaning that they're taking in less money through taxation and receipts. And so, that's why a lot of the debate between the politicians going into November is, how to go forward. Is it taxation? Is it reducing the debt? Is it tariffs? Everyone wants to, find some sort of way other than the direct way of either cutting government spending or through taxation. And so, and when it comes to the actual reports and the data number coming out, I just know that the cost of living will be more expensive the next election cycle 4 years from now, no matter who's president, who's running Congress and in the Senate. And so, taking that knowledge is how do you prepare for the next 4 years? We all want to just be in an asset and watch the asset soar, but you have to do more than just being in an asset. You have to now be aware of that, knowing that 4 years from now, everything's going to be even more expensive. And so a lot of people are talking about deflation, maybe the market declines 20, 30, 40%. But that's not going to really do much as far as what the next 4 years bring. Those are short-term shocks. So you have those nice ebbs and flows. But as labor costs continue to rise, that means wages have to keep on rising. You're going to have that cost, 4 years from now. So if you want that, new kitchen remodel, paying someone to do that 4 years from now is probably going to cost more than it does today. And so you have to think about that and then think about 8 years from now, and that compounds. And so what happens is we do have an asset price correction crash where things fall 30 or 40%. That's going to hurt demand. And so you're going to have like this inflationary, what I call the inflationary depression, meaning that the actual money that you have available is going to be very limited to the basics for food, shelter, and energy, while all the things like discretionary things, if there's no new needs for them, those prices continue to drop. And if you actually look at the CPI report, you can pull in and look at like things like TVs are down 10%, airfares are down. You can see smartphones are down in price. So you can see like a lot of electronic devices, those things are just dropping in price because there's really no like major constant demand for it. And we're still seeing the demand, especially like in today's inflation report, services are near 4%. Those are things like hospital costs, transportation costs, restaurant service costs, right? So those costs continue to rise. And so we really need to focus on, getting that demand back in line with supply.
If I could hit the button, I'd probably get it right. Okay, so that brings me to my next part of this. Do you see, I see you've been promoting and talking about an inflationary recession. I think it's going to be a stagflationary mini cycle of 3-4 month recessions with inflationary spikes and then another recession because of it, et cetera, lasting for years, almost Japanese style, the opposite of their deflation, but a cyclical inflation that persists for years to come. Where's your perspective on that with your inflationary recession?
That's a great point. So I think the issue is, one, America really didn't have a big recession since 2008, right? So it's crazy to say it's a really long time ago, right? So it's 16 years ago when we had the last known recession. And so it's a very long time that we've had like a known recession. And so, you hear a lot of people say there is no recession, there is no recession. And we're talking about inflationary recession, inflationary depression. And so that word gets thrown around a lot. And then a lot of feedback I get is, well, the economy is not in a recession because the stock market's at a record high, and everyone has a job. And I say, well, because everyone has a job, does that mean that we're not in a recession? Because the definition of a recession is very associated to job loss. And so we don't understand and talk about the degrade in quality of life for Americans. And so now This is something that's new that other countries have already experienced. So, for example, look at Europe. A lot of families in Europe, the families live in a house, and it's like generational living in a house, which is now happening now in America, where the families, the kids grow up, they get married, they stay in the house, and then when their parents pass away, they just inherit their house, and then they live in their house, and then they raise their family because they can't get ahead in life enough to buy their own house, right? And so that's a degrade in quality of life. So they may have jobs and they're still working and providing, the basic necessities, but they're not moving up the social scale. They're just getting by. And so that quality of life deteriorates, and we're just told that, well, because you have a job. Well, if you have a job and you have to work Monday through Friday and then also work, a part-time gig job to make some extra money, well, or if you have to do 2 of those or 3 of those, we call that a good economy. And so I don't necessarily like the term recession, and because they just purely associate it on job loss. Now, if we do have a job loss recession, that will definitely 100% put pressure, because the market is priced for insane amount of growth for next year's earnings and then for 2026 earnings. And so if we do have a rise in unemployment, it means there's going to be less money that people have to spend. And so that would put pressure on the market. That's why usually in 2008 and 2000, when the Fed raises the interest rates and unemployment does rise, that the market does go down, because at those peaks, the market is priced for continued growth. And so when unemployment rises, that growth deteriorates, and therefore the market then prices in that lower future growth due to the higher unemployment. So I think it's very interesting, the current dynamics, because we also never ran a deficit that's 7% of GDP before. And so there's just a lot of dynamics that they're all saying that this time is different. Well, this time is different in that, a lot of things that are going on today have never actually been done before. I remember when I got my MBA, and my econ professor told me, he's like, I remember them saying, well, we instead of getting a book, we're just going to throw the textbook out, because in today's Keynesian economics, nothing like running a Fed balance sheet of 5 trillion is in the history books. So we're just going to throw that away, meaning like what we're doing now, there's really no playbook for, or you can't say, well, this happened in the 70s or 80s, because we really haven't been to this extreme debt to GDPs at 120%. So, I mean, we're just massively over, printing money, which has never happened before. And the only time this has really happened is in countries that were experienced, things like hyperinflation or just really bad inflation, right? And so it's just a very interesting dynamic, because those countries that experienced those bad inflationary times, when they were doing the same things that we are, they didn't have the world reserve currency, which is probably one of the only reasons why we haven't had such a massive inflation wave, even higher than what we already have, because our currency is still the world reserve currency. And so that's putting, I think, pressure, or not pressure, but relieving the inflationary pressure, because people still want our dollars. And so our trade deficit came in this week at like around 100 billion for the month. And so China is still accepting our dollars for goods. And because we're buying goods from China, their labor costs are a lot lower than ours, so we can still get cheap goods from China. And so there's a lot of different dynamics that are keeping this charade of printing a lot of money and keeping inflation moderate, quote unquote moderate right now, just because that the demand for dollars globally is still out there. And so that allows us to keep kind of doing what we're doing right now.
Well, I'm going to go straight to it then. What do you make of that story from Bloomberg this week of the Chinese discussing the potential of liquidating $1 trillion in their currency reserves to strengthen their domestic economy? I think that offers some very bad outcomes for the U.S. markets.
I mean, I think short term, it definitely would be pressure if they were to do it all in one lump sum. Obviously, that would be a new issuance. But you also have to remember that $1 trillion worth of debt that China's holding right now. A majority of that debt that they own, because they haven't been buying a lot of new debt from the U.S., a lot of that debt that they're holding are the bonds that were yielding like under 1%. Right. So they were buying, that was a lot of debt that they were owning from pre-COVID. Right. So that $1 trillion of debt that they're owning, those bonds have lost 50% of their value. So even if they sold it I don't think the par value of it is $1 trillion. They made the initial original amount that they bought was $1 trillion, but those bonds probably lost significant amount of value due to the interest rates. It's kind of like what happened with the banks when the banks were buying all those bonds. When they were at zero, and then interest rates spiked, everyone became insolvent instantly because they were holding bonds that lost 50% in value. And so I don't really think that them trying to sell those bonds would be that big of a deal, because those bonds have already lost so much value. And then the Fed, their balance sheet has come down pretty significantly, right? So I mean, shit, the Fed increased their balance sheet by $4 trillion. What would be another $1 trillion to the Fed to come in and just, buy it all up? And if things did escalate as far as global tensions with China, I mean, that would be like kind of like what we do with Russia. We just cut the leg off of Russia, and there's the 10-year yield is still below 4% today. And so, it's always a risk when you're dealing with geopolitical tensions, but I don't think that that's so much of a concern just because of the things that I just mentioned.
Well, after watching Jake Sullivan take his beating this week over in Beijing, I think the concern that I would have is more so if they decide to liquidate all the MBS that they couldn't get rid of in the last downturn. Because Obama never bailed them out, neither did Bernanke. I'm concerned about that because if you were to dump MBS in the market, I think it would have a greater impact than it would just dumping, like you said, short-term treasuries and some of the 10-year treasuries that they've been holding on to.
Yeah, no, absolutely. I mean, that would definitely affect more so the real estate market than the treasuries, just because of that fact, though. Yeah.
I think we're witnessing a turn in the world that people don't understand. If you've never read The Fourth Turning, I highly recommend it, folks. We're sitting in a situation as a reserve currency, like you stated, but we're also sitting at the greatest risk if everybody sat there and said, okay, I've had enough of this. And they slowly, as they have been, phased out the necessity for the dollars in many aspects. The thing I'm wondering about, what would the implications be on our markets domestically should we sit there and try and be even more aggressive with China? I mean, we've seen no indication from either political candidate they're going to back off the tariffs or keep the pressure off of China. China could simply sit there and start putting export tariffs on any goods bound for the United States, and no one's ever thought of that.
Yeah, no, absolutely. As someone who, I look at China as, I think that capitalism is the best way of making the best decisions forward. And so the issue is our government puts in so many regulations in place that it sometimes allows China to maybe try and get ahead quicker, even though they don't really discover themselves. Like they obviously copy our IP a lot, but then they take our IP and then they have less regulatory tape so that they can kind of maybe get ahead faster on like initial beta of something. And so if anything, the government, what they should be doing is want more competition and bringing down the regulations and actually easing tariffs. It's kind of like, for example, when we had the initial oil spike when Russia invaded Ukraine, and the first thing the government was to do was to sanction Russia and to try and ban the imports of Russian gas and oil, which caused those prices to spike, obviously, because we're cutting off supply. And the issue, and by the way, all that did was make Russia more money because prices went up. So by putting tariffs on and sanctions on Russia, we were actually helping Russia make more money by obviously increasing the commodities that they produce, more valuable. And so what they should have done is actually reduce regulations as much as possible and be more competitive on the open market to actually drive prices down, because instead of Russia making more money because of their commodities were going up in price, would to actually suppress the price. And the way that you suppress the price is to increase supply. And obviously that didn't happen. So the dynamics of capitalism is great because you can actually, we always want to be like, well, I'm tariffing, I'm sanctioning, and I'm going to put pressure on that. But all that does is make things harder to produce, harder to get supply, which then drives prices up. And the only people who benefit with higher prices are corporations and government. The consumer always gets hit with higher prices. So, but in free market capitalism, by having the minimal or no regulations and no tariffs and having free market compete you versus me, you're going to find out who the best person is. And so it's kind of like the EV car. If China can create an EV car that's affordable for Americans here, and there's demand for it, why should we not want a Chinese car? And so, because that hurts us. And why is it that they can have a cheaper car than we can produce? Well, their costs are way cheaper. We have much higher labor costs. So we have people who are working who deem a higher labor. So we have to make that pay. So those dynamics that China has in the advantage is the labor costs. And so that's really the issue, is that China has the cheap labor and we don't. And that's why there's this dynamic that, well, we'll tariff. We're going to make your car just as expensive as our car because we want to protect the worker. But in the whole, you're hurting the overall economy. And also those companies, instead of saying, well, don't get that cheaper car on the market because you're going to hurt our profits. Well, why don't you come up with a better car and produce a better, cheaper car than China? Well, that requires more work. That requires R&D. And those companies, they just want to sit back, produce the same car, enhance the car a little bit every year, and keep their margins and their stock buybacks and their bonuses going. And so it's really a distortion of free market capitalism, because by eliminating competition, you're keeping the status quo the same, and that keeps prices high. So, and that's my little tangent on free market and in competition. Basically saying is that I would rather compete with China than trying to put up tariffs and sanctions and blocking China and being a better at capitalism than China and coming up with the better products for everyone and not just out for a certain population.
100%. And I just think that we've refused to acknowledge that and agree to compete. If anything, Russia has become stronger with their divorce from the West. China is looking at what's happening to Russia, tighten their relations there, which is something many of us in the old Cold War days never thought we would see. Moving to the data, which really is a major part of my expression, folks, red ass point with me. You're an economist. You have to make decisions on for clients based on data provided by the government, which has a terrible rate of revision and error in excess of anything that would be outside of acceptable in private industry. What do we do to fix that? Or how do you deal with how do you deal with it on a day-to-day basis, I should say?
It's very hard dealing with constant data that is being revised, and so you really just have to know what you're buying. And so, I think that's actually one of the reasons why, so when you look at asset prices like a stock, when a company beats their earnings, and you look at their stuff, and you're like, okay, they're making more money, they're growing, they have great earnings, so yeah, the stock should be up. But like this week, well, Nvidia, they beat, but their stock is down. When I look at gold and I see gold at the record high and the best performing asset this year, I look at that as that people are nervous. They see all this data and they're like, I don't want to be in a fraudulent stock or market where the data is being constantly revised, because if that's the case, then the projections are being miscalculated. I don't want to necessarily be in bonds, because if I'm a long-term investor, I don't want under 4% return a year on bonds, because inflation on average is 4%. So at best, I'll break even if inflation stays at 4%. So, that's not, that's an okay bet, but not the greatest. And so you have people who are like, well, I would rather just exit that all and know that I want to store a value, something that I don't have to worry about carrying costs. I don't have to worry about deterioration. And so I want something that will hold its value, 5 years from now, 10 years from now, et cetera. And so that's where I think I see why gold is acting the way it is. And gold is, like I like to say, is a fear hedge. Whenever there's turmoil in the markets, scared in the markets, people buy gold, whether it's geopolitical, currency, the economy as a whole. people would rather hold gold than that other stuff. And so recently, just this week, we came out with the news on the Supermicro computer company with their earnings and possible fraud. And so that could be a big exposure of fraud in the market. And if there is any bit of fraud that is highlighted from that company that help boost because they're a client of NVIDIA, if there's just a hint, just because of how overvalued the whole sector is, if there's just a hint of fraud, then people are going to start asking, well, what else is fraud, right? So right now, there's no confirmation that this company is fraudulent. But if it turns out that it does, then that then raises the question on investors, well, what else is fraud? And then people are going to start digging deeper and deeper into what else is fraud. Then if they're one of the customers that help boost NVIDIA's earnings, and they found out that was fake demand. Well, if that current demand was fake, then how can we trust the future demand? Because that demand now fades. And so it can really cascade on itself, especially when you're priced for perfection and things have gone such an inflated valuation that, that's what they say, like the tiniest pin can prick a bubble, right? So if this turns out being the pin, this could be, a cascading effect. And then, looking back at past history, whether it's 2008, all it takes was Lehman, and then next thing you know, next 3 months, you have the market in free fall. You look at, the tech bubble, all it took was Enron, and in 3 months, it went from like the world's greatest company to bankruptcy in 3 months. And so, as soon as that fraud is detected, it can turn real fast, real quick. And so that's why you have to be aware, make sure you protect yourself against these type of things. And if something is too good to be true, it usually is. And so, people should protect themselves from those type of speculations. Make sure what you're investing in and what you're holding is real, and not something that can be caught in fraud.
Well, I'm going to follow up on that because there's breaking news in the last hour since I've gone on the air. We were talking about the impact on the lower and lower middle class with the inflation that's been embedded in the system.
Mm-hmm.
The breaking news, because I work in the high-end industry, yachting, etc. Yacht sales are down, recreational boating's down, RVs down.
I think everything's down.
High-end cars are down. Yeah. Well, guess what the breaking news is from the FT tonight? Sotheby's earnings plunge as art market catches a chill. Christie's also suffering from slowdown in auctions. There's your tell right there, guys. If you're not paying attention to what's going on at macroedge.net/ozone, get your 2-week free trial. Had to get the plug in. But if you're not paying attention to the data we're projecting, that story is a tell that the wealthy have pulled their horns in. And Greg, when you hear that kind of news, you think, oh, hell. Tell me if I'm crazy, but we talked about calls at the 130 level on NVIDIA between ourselves earlier this week. It closed at 119. Mm-hmm. There's going to be some people in pain tonight, aren't they?
Absolutely. Just to the 130s, we're in the billions, and then we're not talking about above the 130s, and even the 125s and 120s. So I mean, there were a lot of people thinking that billions and billions of dollars that are just wiped out tonight. And so the other thing that you point about the wealthy, I just want to say that me being out in California, in the agriculture country and in also wine country, recently this past week, I wrote an article that this is 1929 redux because I was comparing a lot of the leading indicators in 29 that led to that were basically clear indicators that the things weren't well, that in hindsight, you say, well, yeah, look how bad things were. Why would these prices be where they are? And then that's why you'd have the crash. And so one of those things I point out is in the agriculture and in wine. So 2 things. Agriculture is getting massively hit right now. They're destroying crops because what happened was when we got that influx of money supply in 2020 and 21, it created an artificial demand for all kinds of food. Farmers thought that they were going to need tons of new equipment. They're going to need to plant more, grow more, and so they did. Well, then what they found out was that demand just vanished, basically. So now they need to lower and destroy their crops to bring supply back in line with balance. That's now because they already spent so much money on new equipment. There's also a bloat log of inventory of farm equipment now on the market. John Deere said that there's no demand for their products, so no more future demand for future new products for agriculture. And then by looking at the wine industry, LVMH said champagne sales are crashing. That is usually a leading indicator, like in 2008 and 2000. You can look at California wine sales, they're crashing as well. Usually wine is a leading indicator. People are good times. You go out to dinner, you spend a bottle, you get a bottle of wine. Wine prices have surged since 2021, and now when people go out, they would rather not get a bottle of wine. So that type of demand has been just absolutely annihilated. And so those are like leading indicators, and these are typical leading indicators how things are not doing well, like you said, across the board. And you know, a lot of times we closed the week today near within, I don't know, on the S&P 2% or so, or you know 1%, 2% within a record high. But there are tons and tons of stocks that are discretionary stocks that are saying, hey, things aren't so well. And so it can be very misleading. And we, you know, I'm pretty sure everyone listening here already kind of has a spiel that it's really just 7 stocks driving the stock market. And so it's very misleading for the general populace to think that everything's fine and dandy when, you know, a lot of things are not fine and dandy.
Well, that brings us to, we're going to wrap this up in a few minutes because I appreciate you taking the time to join us today, but I have got to sit there and put this one out to you. The closing day today ended with a hanging man formation.
Oh.
And for
oh.
You knew what that means. And if you're not a candlestick trader, trust me, go look up hanging man and go, oh, Greg, care to tell them what that usually means in the bullish reversal world?
Oh man, not good. I mean, they named it the hangman for a reason. So
exactly. Now, I'm going to finish this up with a question for you. It's a 3-part question. You can answer it however you like. This is because you and I can have great discussions online or on the air. So the big question to end this interview, what is going to be the biggest story in September? Another Federal Reserve blunder, a crash below 100 on the U.S. dollar index of the U.S. dollar, or a major disinversion of the 2s, 10s?
all right, let me think here for a second. If based on today, I would have to say that it's going to be the 10-2 spread. Just because I think no matter what the outcome the Federal Reserve does, whether they do lower rates or not lower rates, I think that will cause the curve to uninvert or signal their future rate cut. So, you know, I definitely think they will be cutting either this month or in November. And whether or not that happens, you know, they are definitely going to start lowering the interest rates. And so that means that the curve will uninvert between now and the next 60 or so days. And that's going to start to, I think, create a lot more problems with the credit markets and a lot of things with the banking system as that curve uninverts and people are going to have to scramble on getting their balance sheets squared away.
Boy, I tell you, if the 10-year blows out back above 4 and the 2-year crashes to 3.5, which is where I think we end up before the year is out, that is going to freak out everybody who is a financial planner.
Yeah. I mean, if it was a bear steepener like that, absolutely. So you know, there's the bear steepener and the bull steepener, right? So the ones where if the Fed is cutting because the economic data is just collapsing, you'll have the 10-2 falling at the same time, but the 2 will fall faster, and then you have the bear steepener where if the 10-year rises to 4, but the 2-year then falls, that you know we have the bear and the bull steepener right there. So. You know, but the issue really is that I think that the Federal Reserve, they never really raised the interest rates high enough to tame inflation, and the government is, you know, as we know, is running massive deficits, which fuels the fire, and so those combinations, I would say that we're talking about, last thing for me is that we talk about inflation, deflation, and stagflation, Well, I came up with, because of this one is so unprecedented, unlike anything that we've seen before, and is completely different than anything we've done before. I call this the F the middle class inflation, meaning that the middle class is the ones that get the brunt of the pain, and that if you don't pay attention and keep up, you're going to fall out of the middle class. And then if you can and you own assets and you're doing well, then you most likely you're going to be okay and continue to be in the middle class, if not rise in the middle class. So that's why I call this one, my pin is the F the middle class inflation. So
I think that's an accurate decision, and I think that my personal opinion is we see a beginning of the disinversion next week and acceleration through the end of the month, which is going to be mind-blowing for people to experience. Sir, please tell everybody how to follow your works, where to follow your works.
Yes, absolutely. So as far as analysis that John has been asking me and more in depth, please follow the Coastal Journal. You can find us on X and on Substack. You can find me on LinkedIn personally. If you want, you can direct message me. I'll be happy to help guide and any other questions. And if you want to read more in depth reports analysis from markets to economies to the monetary system, that's what I do. So it's a great follow the Coastal Journal and look forward to continuing and educating and informing everybody on the craziness that we're currently in today.
Greg, thank you so much for your time today. And everybody, don't forget macroedge.net /Ozone, macroedge.net Ozone, 2-week free subscription. Tune in, MacroEdge TV coming soon. Hell, who knows? I might even put my ugly mug on there one day. Maybe not. I'll catch everyone next week for MacroEdge Radio. This is John Galt speaking. Good night.